In this video, I'm going to show you how to identify an inverse fair value gap, how to take entries from an inverse fair value gap, and different entry models you can use. So make sure you stay to the end of the video, and please leave a like and subscribe if you like this content. Alright, so what is an inverse fair value gap and how to identify it? So the first thing we need to know how to identify a normal fair value gap. Now, how does a normal fair value gap looks? It's normally three candles, and how to identify this fair value gap is if there's a gap in the market between candle number 1 and candle number 3. So as you can see here, there is a nice gap resting right over here. So that's an inverse fair value gap. All right, so that is a normal fair value gap. Now, what happens when we identify an inverse fair value gap? So an inverse fair value gap is basically when price retraces to this normal fair value gap and then price breaks through this normal fair value gap and then it becomes a inverse fair value gap. So nice and easy to understand. So let me show you a few examples how we can enter from this. All right, so what we want to look for if we have price doing this, we want to enter from an inverse fair value gap at a liquidity sweep, a point of interest at either a high or at a low. So what we want to do, we want to wait for some sort of liquidity sweep and then price needs to come down. But during this, we want price to create a inverse fair value gap. So basically what we want, if price moves up, it took out the most recent high, for example, we want price to create an fair value gap that has not been respected and then traded back into this inverse fair value gap, and then we take the continuation move in this example to the downside. For example, the same over here. Like I said, there's a bunch of entry models you can use for this. If we break this low right over here and price retrace to this level, what we want to see on the lower time frames is some sort of liquidity that's being taken, and we have our candlesticks there, and then we're going to wait for an inverse fair value gap to happen, and then price retrace, and we continue the move down on the lower time frame. Now, it depends on which entry model you use, but sometimes what happens is if you want to be a little bit more aggressive and not wait for this retest, you can always just enter candle closure below this inverse fair value gap and take the trade to the downside. All right, so here you can see we have the chart open right over here. So as you can see, we created our low that's been liquidity. Liquidity has been taken, and now we wait for a fair value gap to form right over here, as you can see. And then as you can see, price did not respect this fair value gap. We had a candle closure above this inverse fair value gap and price went up. So that's what we look for when we look at here as well. There's a really small fair value gap right over here, really small. When you drag that out, you can immediately see we had some sort of reaction right over there inside of an order block, and then as well liquidity sweep, another inverse fair value gap was created and price closed below it right over here, and then price continued to the downside. Right, so here's that entry. As you can see here, fair value gap top and fair value gap bottom, just to make it a little bit more clear. But this was the first inverse fair value gap that was created after price took the liquidity right over here, and then price broke through, and this is where you can enter your first entry model, as when we have a candlestick closure above the fair value gap, the inverse fair value gap, high right over here, high right over here. So you can enter your trade right over there. So this will be a little bit more of an aggressive entry as we don't wait for the retest. All right, so this was the first entry. When we extend this inverse fair value gap, we can see that we had another entry right over here, and look at the reaction that price gives us. Retraced again into our inverse fair value gap zone. We got an entry right over here, and price made another reaction to the upside. So here you can see the more aggressive one right over here. When price closed, got our 1 or 2 risk to reward. Price came back, got another 1 or 2 risk to reward. This is on the retest, so this will be your safer entry. And then we had another retest right over here for another 1 or 2. And as you can see, when price reacted from this level, there was another inverse fair value gap that was created right over there. We waited for the retest as this entry model, and then price went up again. So you can use an inverse fair value gap in any entry model that you use, but in this example, I'm just showing you the easy ones that I normally trade myself. Sometimes I know it's hard to identify all of it. That's why this is going to be a free indicator, fair value gaps by Flux Chart. This is the settings that I use: the zone invalidation close, the IFVG invalidation close, zone filtering on average, threshold on 50, FVG detection all, and the sensitivity you can play around. There's low, normal, high, and extreme. I like the high. And then you can just choose the settings, and these are the settings I use. Now, how does it look? When we look at this entry model right over here, we had our candle 1, candle 2, candle 3. Price came back into the normal fair value gap, went away from it, never took out this low right over here. Price retraced. Here we broke through that fair value gap, and suddenly this becomes a inverse fair value gap. Immediately on the next candle, we had a retest right over here. Price went up, another retest right over here, and then price went in the zone and it continued to the upside. So this indicator literally draws out the inverse fair value gaps for you. So it makes your trading analysis just a lot easier, and it saves you a lot of time. Here's a nice example of where you entry 1, where you entered straight immediately on this close right over here. In this case, we had an immediate retest as well, and then the next one went up like this. Here is another example of price ranging right over here. As you can see, we created liquidity. We took this liquidity out with this candle right over here. And when we draw out this low right over here, you can see price never took out this low. So price didn't show any signs of continuing downwards. We created our normal fair value gap here, candle 1, candle 2, candle 3. Price did not respect this fair value gap. Price broke through, and we created an inverse fair value gap. So there's a few ways you can do it. You can enter on the close right over here. And in this big example, I would probably put my stops below this breakout candle because it's a huge candle. And then you can wait for price to retrace and enter to go long, or you can enter immediately on this candle and you can get a price upwards. When it's a big breakout like this, I love for the retest because this stop loss is a little bit big. So I will rather wait for the retest and enter on the retest, and then we can continue to the upside. Awesome. So please go leave a like and subscribe. Also, don't forget to type in this indicator here as well, completely free. I'll leave a link in the description to go check out Flux Charts as well on their website and what they have to offer. It makes your trading journey so much easier. Go have a look. Link is in the description, and then I'll see you in the next video. Cheers.